Hello and welcome back again. I hope you are having a nice day. Today we're going to be talking about Tesla, the very well known EV company that's massively trending since like forever. So I feel that this video is actually very important and especially for those people who are contemplating potentially adding Tesla to their portfolio. The thing with Tesla is this company has been in an uptrend for a while now. And of course, it has had its pauses. This happens with every stock. But if you take a look at the 3 year period here, you will see that the company is on a clear uptrend. How do we define an uptrend? An uptrend is happening when a company is making higher highs, is what we call them. So this is a high, this is a higher high, this is another higher high. Then there was a little bit of a lower one, this can happen in between, and then another higher high, and then another higher high. So this is what happens when we are having trending companies. You see that a lot in the markets. And a trend can last for a long time. How do you know it is a trend? So for example, if you, for instance, hit the market trends here, and we take a look at the tab, you will see that Tesla is still one of the top symbols that is actually currently trending. As you'll see, these are the trending now. It's the market trends module. And you notice that Twitter is just above it. I mean, Twitter just gained like 30%, and it's almost like at the same fate with AMC and Tesla here. So this is important to understand because actually trends can be very powerful things and can propel a stock upwards or downwards, regardless of what they are doing in terms of financials. And this is a little bit of a problem, especially for those people who don't really understand what a company is about and how to actually play these financials and what it means for the company. Now, a lot of people who are not aware of how to actually value a company, they may see that there is, for instance, some sort of a temporary, downtrend here. The company went from $1,100 to $850. So they're thinking, okay, it's cheaper. It has been at 1,100. Let's buy. And then it goes up again, and they feel awesome because they bought at a low, and now it's up again. What they don't realize is that this is mostly a luck play. This is mostly a trend play. And if you're a trader, and you are doing this on purpose in actually trading the company, then you are absolutely fine, especially if you are using like technical indicators, and if you are taking a look at the trend of the day, you are trying to align the actual daily chart with the monthly chart. There are all sorts of techniques that you can do as a day trader. But if we're talking about somebody who is actually buying value here, then it's a completely different story. And I really wanted to dig deeper into Tesla's financials so that we can actually discover what is happening with the company and whether it makes any sense to actually buy it. And again, I understand that a lot of you may love the company. I love it too. I love the cars. I actually wanted to buy one, and I still do. They're a little bit more expensive here. I'm actually in Europe right now. But back in the US, they were amazing and a great value, really, I feel. And I think that the company will be selling a lot. However, the company and the stock are two very different things, and we want to be making sure we are paying less than what the company is worth, or at least a fair value, and not too much for the company's stock. So the thing is, when people see this and take a look at the max chart here, which is absolutely insane, look at this. I mean, the company has been going higher and higher. And when people are seeing this, they're like, okay, I need a piece of that. I need a piece of the pie, right? And so they're like, okay, whenever I see a little bit of a downtrend, I will buy. I mean, it's gonna go down a little bit. I will buy because it keeps going up. And so what they are doing is they're feeding the monster here. They keep propelling it upwards, and so this goes on for a long time. This is what trading is like because in its core, the stock market is an auction, and so if people are actually willing to buy, then the stock will go upwards, regardless of what they are doing in terms of financials. However, as a cautious investor and as an intelligent investor, you need to understand that everything ends and everything is a cycle. And so at some point, you will see a crash here. Will this be temporary? Maybe. But you have much less margin of safety than a company that has great financials, because if this goes down, it's gonna be a train wreck. It's gonna be tough to come back up because its financials don't support it. And what do I mean by that? Let's take a little bit of a look. I understand that a lot of you may not agree with this, and you may dislike the video. That's okay. Just listen. Just get some ideas, some opinions, and you can still have yours, of course. So, what's going on here? We're having a P ratio of 234. Okay, so this means that for every $1 of earnings that the company has, we are paying $234 per that amount of earnings, per that dollar. And so basically, this actually means that we need just 234 years to get our money back from this investment. So the price to free cash flow ratio is even worse, is even lower than this, higher than the P ratio, which means that for every $1 of free cash flow, we need to pay $322 to acquire stock. And so again, we need about 300 years to get our money back in that sense. Outstanding shares keep increasing. The company understands that the people keep buying this. They buy and buy and buy whatever, regardless of what's happening with the company. And so what are they going to do? They're going to fund their operations. They need money. EVs are extremely cash intensive. They require a lot of cash, a lot of capital. And so what's the best way to gain capital? Get your followers to pay for it. That's people who are buying the new stocks. And so they keep printing them. They keep issuing more and more and more, as you see here, and keep diluting you. And so if you bought at 2017, you have 25% less intrinsic value on your shares. And now you're saying to yourself, okay, but this goes higher. Yeah, it does go higher, but look at the financials. It goes higher again because of people willing to buy. People are actually following the trend. They have the fear of missing out, and the moment this goes slightly down, they keep buying it. But at some point, everything, every instrument, every stock comes to its senses eventually. And it will happen for Tesla for sure at some point, there's no doubt about it. So, the free cash flow to total liabilities, this is 9 years of free cash flow that we require in order to pay the total liabilities of the company. You can see this with a lot of companies. This is a little bit concerning, but it's not the most concerning thing. The only good thing about Tesla, pretty much, in terms of its financials, is the growth. They have great growth, and as you see here, the net income, free cash flow, everything grows nicely, even the total equity of the company. But the problem is how much you are paying for this growth, because there is always a moment, there is always a time where you are actually paying too much, and it really depends on what we're going to be doing next. Actually, examine the company's financials with our stock valuation tool, which will tell us how much we should be willing to pay for the company objectively, without actually talking about Tesla being amazing and look at these cars and people are buying and I have fear of missing out and all that jazz. And you can also see that the net income margin of the company is 10%. This is obviously low, and this is something to be expected. Car companies have low margins. If you take a look at the tech company, you will see much higher margins here, for instance. This kind of proves you that Tesla is not a tech company, as many people are actually saying, and that's complete nonsense. It's just a car company. Okay, so we're gonna move a little bit and take a look at what is important, what is very, very important, the stock evaluation tool. We really know already that the company is overvalued, like this is obvious. And the thing is, we want to discover how much overvalued it is. You will see here that the revenue growth of the company is obviously great. 52, 37, 70. So I'm going to go with a high value here. I'm going to go with 20, then 25 and 30. I don't think I have ever used these values. These are insane growth here. I don't typically go above 20. 20 is a lot. This is a 5-year discounted cash flow model, by the way, and 20 is a lot. But over here, I'm willing to give it more because the revenue growth of the company is great, and I just want to prove a point here. So, what's next? The net income margins. They were negative, but I'm not going to go with the negative ones because the company has progressed to positivity. And so they are doing 2, 10 in the last couple of years. So I'm actually, again, going to be very aggressive. I'm going to go 10, 15, and 20 here. So I'm going way above what they were doing. The free cash flow margin, again, I'm not going to take a look at the negative ones. These are the odd one out. I'm going to go with the high ones, 115 here. So let's go 100, 115, and 120. And the annual return is 13 is what I always want to be getting. And so let's hit calculate here. And look at that. Okay, we did use very, very aggressive estimates here. These are extremely aggressive. I wouldn't use them personally. Again, this is to prove a point. We're using very, very aggressive estimates here. Like, this is insane over here, these kinds of estimates. 30% for the next 5 years, 20% income margin when they are doing 10 in the last year and minus 2 in the last 5 years. 120 free cash flow margin, they never achieved that. Actually, they have achieved that in the past. They have. But they have also achieved minus 112. So they're a little bit all over the place. And where are we getting here? The low estimates, the low projections are giving us a price to pay today of $157. The medium ones are giving us $329, and the high ones $550. And we're currently at $1,100. We're more than double of our highest estimates here. And so you can very, very easily see, and this is how this tool really helps very, very quickly evaluate how much you should be paying for this company. And you are seeing that we're at least double what we should be at most paying at our highest projections here. Frankly speaking, if you were to ask me, I would probably be willing to pay close to $120 to $130 for Tesla. And I know that this is very unlikely to happen, but you never know. You know, massive drops have happened before. And the thing is, I want to be buying stocks when there are no trends and actually waiting for them to happen. I want to be buying cheap, and then, if a trend happens, then okay. Otherwise, I will be pocketing, the profit of this investment as years progress. And it's going to be much, much safer than investing in an instrument like Tesla right now, which is pretty much anything can happen. And, today it could be 10% up, tomorrow it could be 30% down. I wouldn't be surprised at all. At this moment, Tesla is just a ticker symbol that's going up and down. There is a company behind it, but the people who are trading do not care about the company. They just trade the ticker symbol. They just trade the trend. And so in this situation, it would be fine for you as a trader, again, to enter and trade and try to make some money if it's something that you do, if it's up your alley to actually trade in the stock market. But if you're a long-term shareholder and stockholder, as I mostly am myself, you could never buy this one today. I mean, there's just no way. Okay, so hopefully you enjoyed the video. Please leave a like if you did, that helps the channel. And let me know what you think about Tesla. Leave a comment below. That also really helps with the algo, so that we can push the video a little bit higher, get more people in our community here. And so thank you for that. And again, I hope you enjoyed. Please remember to subscribe if you're not a subscriber. At some point in the next month or two, I will be giving you access to this tool. I will let you know how to access it. And you want to be around and have your notifications, your YouTube bell pretty much ready to go in order to get the news first and be able to gain access to the tool very quickly. Again, thank you for watching this one. In the meantime, take a look at this video that I made earlier, and I'm talking about a great company. It's on the contrary to this one, which is also a great company, but a great company in terms of financials and the stock price, because it's very, very cheap. And this is Facebook. So take a look at this one, and I'll see you in the next video. Bye-bye.